In this video, we'll provide an overview of the gold price prediction for the year 2023. We've gathered insights from In Gold We Trust, reported by Incrementum AG, to bring you a comprehensive analysis. The report covers important factors like the effects of low interest rates, economic slowdown, and rising inflation, and how they relate to monetary policy. We'll also discuss the potential for a showdown in gold prices. The report also examines how different assets perform during recessions, emphasizing the appeal of gold as a valuable investment option in such times. Economic diversity. As we began this year, our attention is captured by the diverse range of opinions about the global economy. With things like high inflation and a potential upcoming recession happening, we needed to study the different viewpoints that help us understand the economic situation. One important thing is to focus on gold. Gold has been in the spotlight as its price remains close to its highest levels ever, whether measured in dollars or euros. This impressive performance shows that gold is still highly valuable as a reliable way to store wealth and protect against uncertainty. There's a growing push to make the US dollar less important in the global trade. In this complex global situation, gold has become important, especially in China and India. The two BRICS countries have been actively participating. They brought in a total of 36,000 tons of gold in the last 20 years. This shows that gold is becoming a strong influence in this changing situation. Anticipating change. Another big clash is coming up, and this time it's about commodities. More countries want to control their resources, and rules about being environmentally and socially responsible are stopping investments in raw materials. The amount of commodities available globally is getting really limited, and their prices are shooting up. The long-term pattern of high commodity demand, which we've talked about a lot recently, is still very strong. It could even be stronger after some problems get fixed. In the next few years, we expect some big changes to happen. These changes will likely to make up commodity prices go up, and a lot of money will be invested in getting resources. This brings us to the main point of our In Gold We Trust report, the upcoming clash over the price of gold. Since 2009, central banks have been buying more gold than they sell. This trend got even stronger in the past year. In 2022, central banks bought about 152% more gold compared to before, getting over 1,100 tons in total. This buying trend has continued into the first part of 2023. People are trying to protect themselves from ongoing high prices, the chance of an economic downturn, and the risk of problems in the financial system. This is important not only for central banks but also for regular investors. Even though gold is almost at its highest price ever, many investors don't seem very interested right now. From our point of view, the next part of gold price going up will mainly depend on how much investors want to buy it. Balancing uncertainty. Based on previous editions' reports from In Gold We Trust, it was anticipated that the consequences of years characterized by persistently low, zero, and even negative interest rates would eventually surface. The principle of cause and effect holds true. Initially, central bankers believed that inflation would only be temporary, like a short-lived high point. However, they were slow to react. When they finally acted, they quickly and strongly increased interest rates. These interest rate hikes were the most significant ones seen in the developed world in the last 40 years. Right now, the economy is slowing down and prices are still higher than usual. This has caused a real challenge in how to manage money, like keeping prices steady, making sure the financial markets are okay, and supporting the economy. It's like trying to balance three things at once. We're also seeing signs that a recession might be on the way. This shows up in different parts of the financial world, not just in bond market, but also in the uncertain real estate market and problems in the banking industry. Even jobs are becoming scarcer. All these things happening together make it seem like a recession is likely to happen soon, maybe even more so ever than before. Recession as a corrective process. But recessions, as strange as they might sound, are a needed part of the economic cycle. They help fix things that have gone wrong in the economy. They make businesses change how they work, make prices match what people want, and fix mistakes that have been made. There's a special measure called the Leading Economic Indicator, or LEI, that has correctly predicted every recession since 1960. Right now, this measure is showing a decrease of about 7.8%, which is much lower than we usually see before a recession. When recessions happen, investments often do poorly, and there's a big drop in the economy. So, we looked into which things do well even during recessions, and which things don't. Here is the thing. Gold is good at making you feel safe, even when the economy is not doing well. Incrementum Recession Phase Model, or IRPM. In this year's report, we explored several interesting topics. We introduced our innovative incremental recession phase model. This model is carefully crafted to offer investment advice for the different stages of the 5 separate recessions. The Incrementum Recession Phase Model, or IRPM, is a unique way to understand how different investments perform during recessions. Unlike other methods that just look at the whole recession period, IRPM helps investors plan better before by focusing on 5 distinct phases of a recession. Each phase has its own features. We'll look at how different investments are made in each phase to see which ones are the best. In the first phase, or Phase 1, markets get more unstable because a recession might be coming. Phase 2 is when things are the most uncertain, and the economy slows down a lot. Phase 3 is the low point of the recession where things are bad. Phase 4 is when things start to get better, and people feel more optimistic. Phase 5 is the recovery phase where the economy grows again. Sometimes shorter recessions have phases that last less than 3 months, so Phase 3 might not be that important. Our model follows a well-known recession definition, and we know that identifying recessions can take time. But knowing about a recession early is important for smart investing. Dividing a recession into these phases helps reduce risk and make more money for investors. It helps them create a good mix of investments that work well at different times during a recession. Gold's resilience during recessions. In Alan Greenspan's word, I view gold as a primary global currency. It is the only currency, along with silver, that does not require a counterparty signature. Alan Greenspan's quote shows his view of gold as a distinct global currency. Unlike regular currencies, gold doesn't depend on agreements or assurances from others. It has worth and doesn't need others to confirm its value. This gives gold a special kind of self-reliance and steadiness that many other currencies lack, as they rely on outside influences or organizations. As we expected, gold is likely a safety net during recessions, and its price goes up around 10.6% on average during these times. What's interesting is that gold does well in all parts of the recession. The biggest price increases happen in the first 2 phases, which is when markets are most uncertain. One reason for gold's good performance in the first phase is a huge price jump of 120.1% during the 1980 recession, which was unusual. In the first 3 phases of a recession, gold is usually better than stocks. But when things start getting better and the uncertainty goes away, stocks tend to do better in the last phases and during recovery. So, gold is a good choice for protecting against recessions, especially in the early stages. It helps prevent risk and keeps a portfolio stable when things are rough in the economy. Silver's performance during a recession. Silver has some good things going for it, like how much is available versus how much is wanted. But it's important to know that silver's price can go up and down a lot, which makes it hard for investors to decide when to buy. So, if you're talking about investing in silver, you need to be extra careful and thoughtful, more than you might be with stocks, bonds, or gold. Considering how the economy is right now, it's important to look at how silver does during recessions. Now, we're looking at how silver performs during recessions and if it's a good option. Silver is special because it's used for both money and industry, which makes it different from many other things. Study shows that how much silver is used in the industry has a big effect on how it does during recessions. Over the recent years, about half of the demand for silver comes from industry. This connection to industry affects how silver price changes during recessions, and on average, it goes down by 9%. But be careful with this average, as there are some cases where silver did really well during recessions, like in the 1970s, and some where it didn't, like in the 1980s. Also, it's important to note that silver has done well both at the start, or Phase 2, and at the end, which is Phase 4, of the past recessions. This can be confusing because it seems like silver should always do bad during recessions. So, when looking at how silver does during a whole recession, this mixed performance might hide how much risk there really is. Gold's value. In Herb Stein's words, if you decide you want to buy gold, you have the weight of the history behind you. This quote from Herb Stein emphasizes that gold has a long and important history as an investment. It means that when you decide to invest in gold, you're following a tradition that has been successful for many years. Gold has always been seen as a way to protect and grow wealth over time, which makes it a reliable choice for investors. To determine the value of gold backing a currency, the central bank's gold reserves was assessed in relation to the total money supply, using the current gold price. It was explored in various scenarios for the growth of the money stock, or M2, a measure of money supply, and created a distribution based on historical data. When we look at all of these scenarios together, we expect the gold price to reach around $4,800 by the end of the decade. The distribution shows a higher chance of prices being even higher than lower. Although models like this have some uncertainty, we've taken a cautioned approach in shaping these scenarios. This includes considering the unique global debt situation, as detailed in this year's In Gold We Trust report, and the historical parallels of money growth in the 1970s. If history repeats itself, our model suggests a potential gold price of about $8,900 by 2030. We ask the timeless question, where is gold headed? And reveal an updated version of the gold price prediction. This update has also included our long-term forecast of $4,800 for gold by 2030. To meet this goal, the gold price would have to go about $2,400 by the end of this year. Throughout the report, you'll find lots of valuable insights. One chapter explored a detailed analysis of the U.S. economy using Incrementum recession phase model to guide investment strategies during recessions. It also explores the fascinating movement of gold from Western to Eastern markets, with a special focus on the dynamics of the Chinese gold market. Background articles enrich the context on different subjects, while comprehensive examinations of silver's role in investment portfolios and a technical analysis of the gold price offer further depth. As we're nearing the end of the video, we hope you gain a clear understanding of these complex dynamics and their potential impact on your investment decisions. Don't forget to hit like and subscribe to our channel. Thank you for watching, and we'll see you again in the next one.